is the BankBeat Community Banking Podcast, and I'm Jackie Hilgert, Editor-in-Chief. BankBeat is the online source for community banking news and opinion. It is published by the same company that has, since 1992, published Northwestern Financial Review magazine. Today, I'm at the Bank Holding Company Association's 2018 Spring Seminar, which offered a high-performance banking panel that featured 3 successful bankers who shared their insights into what it takes to innovate in today's environment. One of those bankers, Steve Daggett, joins us today. Steve is president and CEO of Midwest Bank, Detroit Lakes, Minnesota, a $435 million in asset institution operating 7 locations in what is regarded by those of us who live in the Twin Cities as the North Country. Midwest Bank has strong numbers. Its ROA is 2.40%. Its ROE is 25%, and its efficiency ratio is about 49%. Steve, you've had strong loan demand at Midwest Bank, and you've had high loan-to-deposit ratio. How do you fund this loan demand in a rising interest rate environment?
Funding it is a challenge, regardless of the interest rate environment, and it's been a challenge we've identified as something we're going to continue to place additional efforts on the loan-to-deposit side, and I think our business development efforts are going to be successful. I think that we have used some broker deposits, which we've avoided, but that's largely because we've had a lot of loan growth in the first quarter. We think that's going to level off, and we've really placed an emphasis on the deposit generating. We think there's some opportunities by being aggressive on the interest rate side of it. Because we've got a good margin, we can afford to maybe go a little bit longer. We think that rates, since they have climbed a little bit, maybe people are more willing to tie up money for 4 or 5 years that they weren't when the numbers started with a low 1. We think now that they've climbed up a little bit, we have some opportunities there. We also think there's some opportunities, if they don't, to maybe go the broker route and get money relatively cheap. But obviously, we can't put too much of a reliance on the brokers with our high loan to deposit. So it's a challenge, but it's one that we've identified. But it's been something we've operated over actually a 15-year period. Our lowest loan to deposit was at 90%, and we got up to 114. When we got to 114, we got back down to 100. It's sort of our measuring stick that, okay, we need to really put even more emphasis on it, and we can do that.
You're a former regulator, and you had some opinions on broker deposits.
I do.
Maybe you want to share a couple of those opinions with me.
I know that examiners have strong feelings about brokers, and they usually tie them to that when the Great Recession occurred, that so many of the banks that failed had a heavy usage of brokered deposits. That was not the reason they failed. They failed because of bad asset quality. Well, they say, if they had not had this deposit source, they wouldn't have funded these bad loans. Then put a restriction on their growth and loans. If you have concerns about their asset quality, put restrictions on their asset quality. Don't punish everybody else because of the broker deposits. I know that many times broker deposits are cheaper than the local funding sources. So you talk about a regulatory burden. If we could save 15 basis points on a funding source, that's much cheaper. And the only reason we don't want to do it is because the regulators think that, so many banks failed because they used broker deposits. That's the analogy of a bunch of cars getting in car accidents and they were all painted red. The fact that they were painted red was not the reason there was a car accident. That's the reason I have an issue. One of the things examiners talk about, there's been some change about ICS deposits and CDARS deposits that if you're well capitalized, you're no longer considered rated as broker deposits. However, if your capital levels deteriorate, then they're considered brokered again. Examiners talk about saying, you know what, we're not going to let you know what your rating is and stuff like that because we don't want to put a run on the bank and nothing like that. But think of the scenario where a bank has got a lot of ICS deposits, and these ICS deposits many times are municipalities and that are large deposits, have always banked with you, and they come in and they say, you know what, I'd like to invest more with you, but there's FDIC insurance limits. And we say, you know what, we've got an option through ICS and CDARS that you could have up to $25 million and have it all be insured. They love it, and they say, that's great. Now, put us in that same scenario that we go from being well capitalized, and now we start to say to them, you know what, especially on the ICS side of it. Cedars, at least you got a window there, but on the ICS side, think of us going to that municipality and saying, you know what? I'm sorry, we can no longer have your money market deposit. Well, why can't you have? Well, because it's considered brokered. Well, it's not brokered. I never dealt with a broker. I just talked to you and we brought our deposit over. And so why is it brokered? Well, the regulators considered brokered. Well, why did you have it before and now you can't have it? Well, because our capital levels have dropped to the point that the examiners have concerns. Do you think that has potential? Isn't that self-defeating, their whole point that they don't want to have this get out there that's a potential run on the bank? That doesn't make sense to me. So yes, I have strong feelings on that, and hopefully someday the examiners will see the light.
I hope so for your sake.
Yes.
You've done a really good job developing credit culture at your bank, and that wasn't easy, right? You've had some years where loans were bad.
We had a really good stretch. I've been with the bank for 22 years now, and we had a long stretch where we had really solid asset quality, very low problem loans, and really did well. But then we had a stretch, about a 3-4 year stretch prior to the Great Recession, and where our responsiveness to credit was just done by email, which we always had been doing. But it wasn't the best approach. Because we didn't have the discussion, we saw a deterioration in our asset quality. So we really looked at, we've got to change our process on it. We really adopted an officer loan committee approach. And every bank has a loan committee. But where I think ours has been a little different is we've incorporated every single member of the bank on the lending team as a member of that officer loan committee at least once during the year. And we rotate them quarterly. And when you mention a credit culture, I think that's what we've done a good job by everybody being involved, even people that aren't voting members. What they're able to hear is we're driven by repayment capacity. We're not driven. We can be flexible in collateral if we need to be. But repayment driven, we've got to be really focused. And we focus and we mention that every single meeting. So anybody who's on that committee for a quarterly basis, every single week, they're hearing about reinforcing our credit culture. I think as a result, that's where we've really seen after that, over a 22-year stretch, we've had about a 3-year stretch that wasn't good, and the last 7 years have been really good. And I like to believe that it's largely, part of it's because we're in a good area and the economy's been pretty good, but I think it's largely a function of re-emphasizing that credit culture on a weekly basis.
Thanks so much, Steve.
My pleasure. Thank you.
This has been the BankBeat Community Banking Podcast. Our sponsor for this edition is the Bank Holding Company Association. Information on the Bank Holding Company Association or a list of its upcoming events, go online to www.thebhca.org. I'm Jackie Hilgert, Editor-in-Chief of BankBeat. Thanks for listening.